During this video clip, we are going to cover the financial sector. And I believe that it was going to be a good opportunity to talk about a repeat of the financial crisis of 2008. I think there are some circumstances that we can cover. For instance, in China, we are seeing problems with Evergrande, like in a similar fashion as in the 2008 and 7 crisis in the United States. And also we have some issues in terms of regulations for the crypto space. So if something goes wrong and one of these companies go in bankruptcy, so we are going to have different problems similar to what we lived during the great financial crisis in 2008. So before starting with the financial sector and explaining the role of the financial sector after the time in which we have the rise of the neoclassicals and monetarists and up until today, yes, I think it's good to say that through the late 1990s and 2000s, many banks had massively increased the lending, and also many mortgages were granted, especially in the United States, to people that were unlikely to be able to repay them, especially if house prices stopped rising, and that happened in 2008. Currently, actually, house prices are increasing, but things can change very quickly if the central bank starts increasing the interest rates as we expect in 2022. So in 2008, this gave way to the subprime debt crisis, which made banks very vulnerable to an economic downturn and or to worries by depositors about banks' viability. So in 2007, several small banks were in difficulties and some had to be bailed out. So in 2008, Lehman Brothers, which was one very important organization in the United States, also collapsed and was liquidated. So this produced in the world like major worries about banks having too little capital, too little responsibility against losses. And obviously that increased real danger for many that they will collapse. So lending between banks dried up. So we had like 3 days during that time in which they were not like lending money to each other. That generated panic in the economy and bank runs. A similar issue could happen, for instance, in the crypto space, as they are not very well regulated. So moral hazards and other problems like relevant to the health of the portfolios of that certain stable coins, for instance, have to replicate the prices of dollar or gold, that can create like a new crisis. So I was saying that the lending between banks dried up, and several banks has to be bailed out by the governments. Here in the UK, we have like a couple of good examples, Northern Rock, and as well we have the Royal Bank of Scotland. The financial crisis led to a very deep depression in 2007. Not as much actually, even with the pandemic. I think the crisis of 2007 was actually worst. I think the central bank at this time, I think he acted very quickly back in 2007, was like a panic and like many uncertainty for many days. and the central bank didn't act as soon as he saw banks not lending money to each other. Anyway, the financial crisis led to a deep recession in many developed countries. For example, the economy in the United States shrank 2.5% in 2009, and in the UK 4.3%. I think because of the UK obviously had like a very strong dependency on the financial sector. So the impact of the banking crisis on the economy was in a scale that many debates in terms of economics follow. Even the Queen Elizabeth II, on a visit to London of a school of economics, is very famous when she asked economists what they had got this so wrong, because economists did not predicted the crisis. And since then, you have seen how Boris Johnson have actually replicated these comments from the Queen. I believe that in part is the same problem that we are having now with the stable coins. When we say that there is a danger, I think we have as well like the opposition, particularly from investors in the crypto space and stable coins more generally, because the stable coins are artifacts of trying to replicate the prices of other commodities and currencies, for instance. So when we say that there are certain risks in regulations and in the risks that these funds are taking to replicate the currencies or commodities, probably they are not listening like with a lot of attention, because they are in a very euphoric moment, very similar to what happened in the crisis of real estate markets back in 2008 in the UK and the United States. And also there is a very strong relationship with the current crisis in the real estate market in China because of the default of Evergrande that is actually coming. I believe is unfortunately coming, and that can cause serious damage to the growth of China and the drop of commodity prices, because China is a very strong customer or client to the sector in commodities. So what were the economist explanations? In general, economists tended to say that governments have intervened too much into the economy. That was the explanation of the political right, and the political left, if we can say that, in terms of economic sectors, say that it was regulation. So that ended up regulating the financial sector at a point in which we have macroprudential rules in which they needed to increase, for instance, the capital to be more accountable if the banks fail. Yes. However, we still have the problem of too big to fail. You can see how JP Morgan, for instance, and many other institutions are just way too big for any government or the government of the United States to let that bank to fail. Yes, and that has a lot of similarities as well with what we lived back in 2007 and 8. So that was like the stand from the economic or the political left and the political right. So there are some others that argued as well that the tighter regulation should not imply to involve or to involve increasing the loss of absorbing capital that banks are required to hold. And they would advocate for return to controls on flows of credit rather than regulation. But I think we actually stopped that type of policy of controlling credit, a policy that we had back in the 70s. Okay, guys, with this long, rather long introduction to what we had in the financial crisis of 2007 and 2008, I want to introduce the concepts that we want to cover today for the financial sector. All these crises, the crisis in 2007 and 8, the unemployment levels in 1980s, the crisis of inflation in the 70s, and a period of targeting coming from the new classical, like a consensus between the new classical and the new Keynesian school. The political of inflation targeting has shaped what is today the financial sector. Okay, so let's go to my full desktop and I will share with you these slides. So we start here then. We are covering the section 18.2 in the Sloman book. In general, then, I will ask you to read the meaning and functions of money. That is a section that I believe is important, especially for those students that are less advanced to the topic of the financial system. They cover what is money and what is the functions of money. I believe that is a soft topic that I would like you to cover if you feel that you need a little bit more of notions and definitions that I believe they are like at a lower level of the university. So the role of the financial sector. So first of all, we have expert advice. So expert advice, yes, in general I would say that banks have the appropriate person to deliver good advice. Sometimes they do not provide very good advice. I think we have seen how we have the crisis of 2007 and 8, particularly during that time, as we covered before, banks lent without responsibility and to an extent in which they probably thought that they were going to be bailed out anyway because governments were not going to let them fall. And I think like the policies that followed the 2007 and 8 crisis proved them right. They didn't let, because for obvious reasons, without financial system, it's almost impossible to sustain the mechanisms of capitalism. Yes, if your money is not you are not able to get your capital from the bank, I think you are going to be in trouble, basically. Yes, so capitalism cannot exist without a financial system. So another thing is that the financial sector are experts in channeling funds. So what they do is to receive money from depositors, yes, and they transform that into loans. Yes, and that is one of the most important functions or roles of the financial sector. They are able to do that. Obviously, they have the expertise to lend the money with responsibility. A second or a third functions of the central bank relates to maturity transformation. So maturity transformation means that these deposits come with different maturities. Yes, maturity means that the monies can be taken out from the time at any time. Sometimes they have money that is going to stay for longer periods of times in the bank. But in general, as they have many customers, they are allowed to use those monies to provide loans from now to 5 years, or even 10 years, or mortgages from now to 30 years. So as you can see, there is a maturity transformation, meaning that the duration of money can be increased or decreased with different type of investments that banks can use. So in general, this time or this the length or the duration of this deposit is changed, yes, into other things such as loans. Another thing is that they can transform risks. So as they have portfolios of clients, they are not like giving up all the money to just one person. So as they have many persons in doing that, they are going as well to transform the risk. So the risk will decrease as they have a portfolio of loans, for instance. Okay, this question is for you. Why may money prices give a poor indicator of the value of goods and services? In terms of the broad definition of money, would a deposit account passbook count as money? You can go to this website and post your answers. Actually, if you go there, you are going to see some answers that other students wrote before. So you can pause the video now and meanwhile you try to answer these questions. Okay, so if you started the recording now, we have actually here some answers. I wrote some answers here back. So some student asked me to get a little bit more of wording if you want to explain the points of these slides. So the first question is why money prices give a poor indication of the value of goods and services. So the money prices can be distorted, yes, particularly if we look at microeconomics rather than macroeconomics. We have different type of markets. So monopoly is a market in which a certain company can have a power over the price. So in doing that, they can distort the price, and when you distort the price, that can be a poor value indicator of the value of, or the real value of a good. Yes. Also prices or money prices do not take into account externalities. Externalities is when we pollute, for instance, or when we change the climate of the planet, or when we deplete the resources of the sea or any resources such as forests or rainforests. Another example can be when we just create harm for the nature in general, right? So these are externalities, things that are not taken into account in the prices. And also because money prices are as well like a poor indicator of the value of goods, because they simply add up the money incomes of individuals rather than measuring what is the difference of incomes between these individuals. That is, what is the distribution of income. So the value of money may be eroded by inflation. Recall that inflation are the price levels in the economy. If you have a salary of 40,000 or 30,000, if prices go up, you will be able to buy less with your salary. So in that regards, as you can see, prices or money prices are a poor indicator of value of good in the presence of inflation, because that also hit the distribution of income. Particularly, inflation hits worse the poor. Yeah, in general, well, rich people have assets that will increase with inflation. The poor people, they have less assets and salaries or cash that are going to decrease with the erosion of inflation. Okay, so So in terms of the broad definition of money, so I think we have here the second question. In terms of the broad definition of money, would a deposit account passbook count as money? I think we didn't cover the broad definition of money, but I think the broad definition of money means that we have a certain liquidities. So cash or money is a notion that I will say is at least funny, yes, because you have different type of assets that can be counted as money. A question, for instance, would be, is gold money? I would say yes, you can transform that gold into a cash or into the currency, and then you can make it like the basic definition of money, which is cash, right? What about a house? A house is less liquid. Liquidity means that you can transform with more difficulty the house into a more fluid, like into a flow of cash, right? So yes, you can sell the house, but it will take you some time to sell the house, so it's not as liquid as money in in your current account or in your savings account or as cash. Yes, it takes longer time for that asset to get liquid. So the passbook itself, where you write the checks, is actually not money, and it is not most of the time, although there is a business in which sometimes people sell and buy checks, yes, at a discount rate. So the money itself is the deposit, is the money definition, but not the passbook itself. Yes, money has at least a potential to become cash if and only if that cash is guaranteed by the person who issued that check. Okay, so the answer for the question is no, the passbook itself is not money. Now we are going to cover this summary of concepts. I will ask you to read this like in a few minutes. I'm going to stop here for you to read all these definitions. I will not be able to cover them all, but I have the definitions here. I will just cover some key concepts that I believe are, in my opinion, a little bit problematic for students to understand. So pause the video here and start reading these concepts. Okay, so if you stop the video here, I would like to refer to a few concepts. Financial intermediaries, okay, I think you can think of a bank. Maturity transformation, we covered that already, so the transformation of deposits into loans of a longer maturity. Maturity is time, the time in which they need to pay back the deposits, for instance. Risk transformation, we covered that. Retail banking, banking for individuals like you and me. Wholesale banking, that is the banking for the big boys in the market, for the large scale companies and banks as well. Financial deregulation, well, reduction of legal barriers, laws, etc. Monetary financial institutions, these are banks, building societies, the Bank of England, etc. Yes. Money market is the market of short-term debt instruments, for instance, the treasury bills. Although sometimes you will find that this concept is not just for the bond market, yes, all the bonds such as the treasury bill. They also refer to the market of forex and equities. Sometimes when they talk about money market, you will see out in internet they refer as well to these three markets, yes, bond, forex, and equities. Sight deposits, I think this is a very interesting topic. The sight deposits are deposits that can be withdrawn on demand without penalty. So sight deposits are, for instance, the deposits that you have within your bank, yes? You can have a sight deposit, and you can just withdraw the topic at any time. And the difference with the time deposit is that with the time deposit, you will need to tell the bank with some anticipation that you want to withdraw your your deposit, and probably you will incur in a penalty, right? So that happens sometimes with certain loans. They act like a time deposit, because if you repay that loan, you will end up not saving an amount of money that the bank is paying you back. So in doing that, what the bank is actually doing is creating a time deposit when they issue a loan to you. Certificate of deposits. Certificates are fixed term interest rate bearing deposits. So banks usually issue certificates of deposits. You can buy a certificate of deposit. They will pay you certain fixed amount of interest rates through the year, and they are actually very liquid. You can resell these certificates of deposits, and it's not just individual banks buy certificates of deposits to each other. Right, I think this concept of repos is one of the key concepts, because sometimes students get a little bit confused about this. So think that I have an object, say that I have this pen, and let this pen, this is actually an electronic pen, let this pen be of gold. Yes, it's black, but imagine that it's made of gold. And I have this golden pen for many years, and suddenly I need cash because I have to repay a debt or something like that. Yes, so, but I do not really want to just sell my pen, because I have a certain appreciation for this gold pen. So that is when a repo comes into action. I can use like an underlying asset to create this repo. In my case, I will use the asset of this golden pen. So what I do literally is to use this asset, yes, and I am going to ask you, or any other, any financial institution, to lend me money, and I'm going to, not lending money, I'm going to sell my pen, and I am going to commit to repurchase the pen in the future, right? In doing that, I will pay as well like a premium for all the transactions. So the person who, the financial institution who made the favor is going to get that premium in the future. That is a repo, yes? So a repo is a contract in which I commit to repurchase the certain asset that is mine in the future. And reverse repo is the opposite. Reverse repo is when you are actually buying that object or that asset. In general, there are sometimes bonds with the faith that the person that is needing the money is going to repurchase that or is going to buy back that object or that bond or that golden pen to you. So that is actually the concept of repo and reverse repo. With this, I think, guys, I pretty much covered the topics that I wanted to cover so far for this slide. There are other notions here. I believe that these are the most important. You can read the rest: market loans, short-term loans, bills of exchange. So there are certificates of yes, that you are obligating yourself to repay an stated amount of of money in certain date. Yes, usually this is 3 months. Treasury bills, these are bills from or notes or bonds from Bank of England. Discount of market, when bills of exchange are sold of both at a discount below the face value. This is usually, the discount market is usually, or discount rate is always linked to a bond. When the discount rate goes up, the price of the bond goes down, because there is an intrinsic relationship between the both of them. At this very time, we think that the discount rates are going to go up, yes, because we are facing inflation, so everybody is thinking that the bank is going to increase interest rates. So if interest rates increase, price go back. If the opposite happens, then price will go up and interest rates go down. Okay, guys, with this I finish this slide. I think I covered the most important topics that I wanted to cover with you today, and in the next section I will make a different video because this one is getting in size a bit too long. I will cover the balance sheet of the Bank of England and other related topics for the role of the financial sector. So see you shortly.